Whether you just started investing or not, if you are one looking to build a diversified investment portfolio, ETFs are one of the easiest ways to do so. And now in this video, I'm going to go over 5 of the top international ETFs that are currently available in the market. And by the end, you'll see which one is my current favorite and why. But before we get started, my name is Danny Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, the first ETF to mention here is the most popular one in the market right now. That is the Vanguard FTSE Developed Markets ETF with the ticker of VEA. Now, Vanguard's international ETF VEA currently tracks the FTSE Developed all cap excluding the US index, which means it provides a convenient way to match the performance of a diversified group of stocks of large, mid, and small cap companies located in Canada and the major markets of Europe and the Pacific region. And so the first data point to mention here about this fund is that VEA initially launched in July of 2007, but more importantly, VEA is currently the 6th largest ETF in the market based on its size, where the fund currently has $202 billion in assets under its management. Knowing that, the fund is also very cheap with a 0.03% expense ratio, which means for every $10,000 that you invest, you would pay $3 per year in fees. And do know that those fees are automatically taken out of your investment over time. They're not something that you have to pay separately. But besides that, VEA currently has 3,853 holdings in the fund, where you may have heard of top ones like Samsung or Nestle. And if we were to add up the top 10 holdings together, they make up just over 10% of the entire fund's weight. So this fund is very well diversified across many stocks outside of the United States, and you can also see the technology exposure has about 11.61% of the entire weight toward the fund. Not just that, but the largest country that makes up this ETF is Japan, with almost 21% of the entire weight. And the dividend yield over the past 12 months, it computed 3.05%. But one thing to realize is that many international funds pay a high dividend yield and they are not very tax efficient. So if we look at the potential qualified dividends that you could reap if you were to hold the investment long enough, as of 2025 reports, that shows the potential of about 66% in qualified dividends. And so if you don't know what that means, any qualified dividends are considered to be taxed at the long-term capital gains tax rates, which means they are more favorable rate. So while I'm mentioning this, understand that as an overall, many international funds are not very tax efficient, and a personal note of mine is that if you are one looking to gain exposure outside of the United States, that funds like this are best suited for tax advantaged accounts like the Roth IRA, instead of a normal taxable account that many of these funds could really drag down your portfolio's returns over time. But knowing that VEA pays out dividends on a quarterly basis, and international stock as a whole has actually done very well over the past year, it's even outperformed the United States, where VEA has actually grown just over 35%, where if we look at the Vanguard S&P 500 ETF VOO, that has recorded to have about just half the performance of VEA, where VOO is currently sitting at 17.8% of the growth over the past year. But long term, the US economy has proven to be a superior investment, and is why investors like Warren Buffett recommend the S&P 500 to pretty much any investor. But aside from that, looking at VEA's average over the past 3 years, it has computed about 18% of growth per year. Over the past 5 years, that is 9.21%. And over the past 10 years, VEA has averaged an 8.75% annual return. Which, while we're looking at this, also understand that these data points include the expense ratio factored into them, and assumes that dividends are being reinvested back into the fund. All right, so knowing that about VEA, let's now go over the number 2 international ETF, that is the iShares Core MSCI EAFE ETF with the ticker of IEFA. Now, IEFA is very similar to Vanguard's VEA, but now the fund is specifically composed of large, mid, and small cap developed market equities, excluding the US and now Canada. And so if we look at VEA, you can see Canada makes up about 11% of the entire fund, where IEFA, on the other hand, has zero exposure to Canada. Now, there are a few other factors that are different there, but realize that IEFA initially launched in October of 2012. The fund is currently the 8th largest ETF in the market, by currently having $169 billion in assets under its management, where IEFA has an expense ratio of 0.07%. The fund currently has 2,591 holdings, where the top 10 make up just over 11% of the entire fund. So this is also a very well diversified investment, and you can also see that the amount of technology exposure is only 9% of the entire fund. Besides that, Japan makes up just over 24% of the entire weight, and if we look at the dividend yield over the past 12 months, it's reported to actually distribute a 3.4% dividend yield, and it was reported as of 2024 to potentially reap 84% of those in qualified dividends to those that held long enough, but do know that their dividends are paid out on a semi-annual basis, so that's every 6 months. And then if we look at the performance of IEFA over the past year, it has grown just about 32%. Over the past 3, it's averaged just over 17%. Over the past 5, it's averaged 8.79%, and over the past 10, that is 8.29%. All right, knowing that about IEFA, the third one now to mention is the Vanguard Total International Stock ETF with the ticker of VXUS. Now, VXUS seeks to track the performance of the FTSE Global All Cap excluding the US index, which measures the investment return of stocks issued by companies located outside the United States, providing broad exposure across developed and emerging non-US equity markets. So this fund offers additional exposure to emerging markets, unlike the previous two, and it contains many more holdings where you can see it has 8,646 total holdings. Now the fund was created in January of 2011. It has $127 billion in assets under its management, an expense ratio of 0.05%, and of those thousands of holdings, the top 10 make up just about 10% of the entire weight, and technology exposure is about 15%. On top of that, you can also see the largest country is Japan with about 15% of the weight there. And then over the past 12 months, it's distributed just about a 3% dividend yield, where the qualified dividends as of 2025 were reported to potentially reap 58.5% in qualified dividends. Now on top of that, VXUS pays out dividends on a quarterly basis, where over the past year, the fund has grown at just over 32%. Over the past 3, it's averaged just over 17%. Over the past 5, it was about 8%. And over the past 10 years, VXUS has averaged 8.54% in growth per year. So far, the biggest thing to realize here is that Vanguard's VXUS offers the broadest amount of exposure to the entire international market of all the ETFs I'm even mentioning in this entire video. So if diversification is what you are looking for, VXUS may be a top option to consider. But here's when things get more interesting, at least to me, because the next 2 ETFs offer even more growth potential. So let's first go over the number 4 international ETF, that is the Invesco S&P International Developed Momentum ETF with the ticker of IDMO. Now before I move on, also know that I've created an entire index fund cheat sheet completely free for you that covers some of our top ETFs in the market, which I'll have that directly linked in the description below for you. Which, while you're at it, consider joining our newsletters so that you can stay ahead of your finances. But as far as IDMO, this fund is actually based on the S&P World Excluding US Momentum Index, which means the index provider first calculates the momentum score of each stock in the index by evaluating the percentage change in the stock's price over the last 12 months, excluding the most recent month, and then it applies an adjustment based on the security's volatility over that period. All in all, this momentum style approach is a very interesting one to know about, and do know that IDMO has actually been around since February of 2012. The fund currently is smaller than the previous ones mentioned, where it has $3 billion in assets under its management. It also has a higher expense ratio, but for some, that potential growth that you're about to see may very well intrigue you more than the cost of the fund. Which, not to mention, the fund currently has 182 holdings, with top ones like Rolls-Royce or Shopify, and if we were to add up the top 10, they make up about 27% of the entire weight towards the fund. Which, not to mention, but another interesting point that might be nice for some of you is that the overall tech exposure is actually just under 4%, and the largest country that is in this fund is Canada, with just under 19% of the entire weight. Moving on from there, you'll notice the dividend yield over the past 12 months was just about 3.6%. The fund also pays out dividends on a quarterly basis, and more importantly, over the past year, the fund has grown at just over 42%, which is by far the highest of the ones I'm mentioning in this video. And then if we look at the past 3-year average, that is 24.5% Over the past 5, it is just over 14%, and the fact that there is more than 10 years of data to look back at here, I really like how we can see this fund has averaged about 12% of growth per year, which is by far the highest of all the ones I'm mentioning in this video. Now, this next ETF is also a very solid option to consider for even more growth, but it doesn't have a full 10 years to look back at, and that is through the ETF, the Franklin International Low Volatility High Dividend Index ETF, with the ticker of LVHI. Now, this fund is also a very interesting one to know about, where it currently tracks the Franklin International Low Volatility High Dividend Hedged Index, which is composed of equity securities of developed markets outside the United States with relatively high yield and low price and earnings volatility. And so more about this fund is that it tracks an underlying index constructed to systematically select approximately 50 to 150 securities from the investment universe and can provide consistent growth potential by focusing on high quality companies with healthy and sustainable dividends and by employing a currency hedge. And so the key things to know about LVHI is that it was initially created in July of 2016, so we're only a few months away from hitting that 10-year mark. The fund is also relatively small, where there is $4 billion in assets under its management. The downside with LVHI is that it is the highest expense ratio of all the ones listed in this video, that is currently 0.4%. And then if we look at the total holdings, it currently has 186 holdings, where the top 10 make up just about 22% of the entire fund. But do notice how there's actually currently, at the moment, no technology exposure in the fund. Besides that, Canada is the largest country by weight that has about 16% of the entire fund. If you look at the dividends over the past 12 months, it computed to have the highest potential one at almost 5% of a dividend yield, with about 44% in potential qualified dividends as of 2024 report. Which, not to mention, the fund pays out dividends on a quarterly basis. Over the past year, it's actually grown the least out of the ones I've already mentioned at 27.1%. But if we now look at the longer averages, over the past 3 years, the fund has averaged about 20% of growth. Then the past 5-year average was 16.22%. And we don't have enough for that full 10 years of data to look back at, but that will be a very interesting one to compare when the time comes. All in all, these are 5 of our top international ETFs. And if you want to see a few more and compare others with data all in one place, like I said, I highly recommend checking out our free index fund cheat sheet that we'll have linked in the description below. But if I were to sum up the choice between each of the 5 ETFs and what they're best for, I would say VEA is best for balanced growth. I would say IEFA is best for balanced growth, excluding Canada, if you were one that would prefer that, where I would then say VXUS is best for diversification, IDMO is best for growth, and LVHI is best for getting an income and growth potential. Which, like I said, don't forget to check out our free index fund cheat sheet linked in the description below, and also to consider joining our free newsletters, which, while I'm also mentioning it, if you want to start investing on a new platform, check out other free content or even some of our top investing tools and resources. We'll have direct links in the description below for you. End of the day, our mission at InvestLane is to help you save and invest wisely to build lasting wealth. So please do whatever you believe is best for your situation. This is not financial advice, and you must do your own research. Which, if you found value in this video, don't forget to hit the like and subscribe button for future content like this.